Now, there are three main ways a central bank can manipulate money supply. And this is through increasing or decreasing interest rates, increasing or decreasing the reserve requirements, and through open market operations. Now, reserve requirements is the minimum amount of cash that banks and other depository institutions are required by law to keep on hand and which may not be used for lending or investing. So in other words, the reserve requirements is the amount of money the banks need to have available to its users to facilitate withdrawals, check cashings, and other activities. Now, in the US, you have two main rates. You have the Fed funds rate and the discount rate. And for the EU, there are three rates. You have the main refinancing operations rate, you have the deposit facility rate, and the marginal lending facility rate. Now, whenever reference is made to the US interest rates, this often refers to the Fed funds rate. And whenever reference is made to the European interest rates, this often refers to the main refinancing operations rate. Now, the Fed funds rate is set by the Federal Reserve as the rate that banks should charge each other for overnight loans, and the main refinancing operations rate is the rate set by the European Central Bank as the rate that banks should charge each other for overnight loans. Now, the European deposit facility rate is the rate that the European Central Bank will pay central banks that deposit their surplus funds with the European Central Bank. Now, the discount rate is the rate that the Fed charges banks when it lends the banks money. And this amount is higher than the federal funds rate, so it's used as a last resort for banks needing some cash to boost their reserves. Now, the discount rate is the same as the European marginal lending facility rate. Now, each bank has a different level of reserves at the end of the day. So banks with surplus reserves lend money to banks with insufficient reserves. And the rates that banks charge each other in the US is the Fed funds rate, and in the Euro it's the main refinancing operations rate. So banks with surplus reserves will lend money overnight to banks with insufficient reserves. And banks that aren't able to get money from other banks must borrow money from the central bank. And in the US, the central banks will charge other banks a discount rate. And in Euro, the central bank will charge other banks the Euro marginal lending facility rate. Now, open market operations refers to a monetary policy tool in which central banks buy and sell bonds to regulate the money supply in the economy. Now, when a central bank buys bonds, the money supply expands, bond sellers acquire money, banks increase their reserves, allowing them to expand the money supply through the extension of additional loans. And whenever the central bank wishes to decrease the money supply, they instead sell bonds. Okay, so a central bank can manipulate the money supply by decreasing and increasing the reserve requirements, by increasing or decreasing interest rates, and through open market operations.